Imagine this, you're in Beijing in 2025. You step into a bustling street market. Vendors are shouting, people are scanning QR codes, and instead of pulling out cash or even Alipay, you just tap your phone. But this time, it's not linked to a bank or a private company. It's linked directly to the People's Bank of China. You just paid with digital state money. That's the Digital Yuan, or e-CNY, the most ambitious central bank digital currency experiment the world has ever seen. And here's the kicker. While most countries are still debating whether they even need a CBDC, China already has hundreds of millions of transactions completed, billions in circulation, and partnerships with global banks testing its cross-border use. So in this video, we're going deep into the Digital Yuan case study. We'll uncover why China launched it in the first place, how ordinary citizens and businesses reacted, what challenges came up in trials, and most importantly, what lessons global central banks are secretly learning from China's experiment. Stay till the end because we'll also discuss how this could affect you, your bank account, your job, and even how your country does business internationally. To really understand the digital yuan, we need to rewind. China has been a world leader in digital payments for over a decade. By 2019, cash use had dropped dramatically. Street vendors, taxis, even beggars used QR codes through Alipay and WeChat Pay. These two giants processed over 90% of China's digital transactions. Now imagine the government watching this and realizing most of the country's money flows are controlled by two private corporations. Transaction data, who buys what, where, when, sits in private servers. And internationally, the US dollar still dominates trade. For China's leaders, this was a strategic vulnerability. They wanted control, transparency, and independence. Thus, the Digital Yuan project began in 2014, quietly in research labs. By 2020, it hit real-world trials. And unlike many countries still stuck in white papers and theories, China said, "Let's actually launch and test this." This bold move gave them a huge head start. And that's why the world is watching. China's rollout strategy was fascinating. Instead of forcing adoption, they gamified it. They introduced digital red envelopes, free digital yuan distributed to citizens through lotteries. Winners could download the official e-CNY wallet app, load the currency, and spend it at partner merchants. In Shenzhen, 50,000 residents received 200 yuan each to spend. In Suzhou, the government tested offline payments using near-field technology. In Beijing, ahead of the Winter Olympics, foreign athletes and tourists were allowed to use e-CNY without a Chinese bank account. Features tested: peer-to-peer transfers with no bank middleman. Programmable money. Some red envelopes expired if not spent in a certain time frame. Cross-border use with Hong Kong and Macau. Integration with businesses like McDonald's, Starbucks, and Didi, China's Uber. By 2023, more than 260 million people had downloaded the e-CNY app. That's larger than the population of most countries. But adoption wasn't just about numbers. The government wanted to see, would people trust and prefer a government-issued digital currency over the convenience of Alipay? Public reaction, citizens, merchants, banks, the reactions were mixed. Citizens, many younger people liked the novelty. They said, "It feels like a more official, safer version of Alipay." Older generations were more cautious, asking, "Why do we need this when what we have already works?" Merchants. For businesses, the key advantage was lower fees. With e-CNY, transactions settled instantly and directly with the central bank. No waiting, no bank charges. But the downside? They needed updated systems to accept it. Banks. Here's where it gets political. Commercial banks were caught in a tricky spot. On one hand, they distributed e-CNY wallets and supported the rollout. On the other hand, they knew If customers start holding money directly in CBDC wallets, deposits in banks will shrink. That means less money for banks to lend, fewer profits, and potential instability. So while the digital yuan didn't destroy the banking model overnight, it raised serious questions about the future role of commercial banks. And every central bank around the world took notice. Privacy and control concerns. Let's talk about the elephant in the room. Privacy. The digital yuan allows the government to see transactions in near real time. Officially, China says it follows a principle of controllable anonymity. Small transactions can stay private, but larger ones are fully traceable. But critics point out, this gives the state unprecedented power. Imagine if every purchase, a train ticket, a donation, even a book, could be logged, analyzed, and possibly restricted. This is why Western central banks reacted cautiously. The European Central Bank promised its digital euro would include options for offline anonymous payments. The U.S. Federal Reserve repeatedly emphasized privacy concerns as a barrier to adopting a digital dollar. China's trial taught the world, CBDCs are not just about technology, they're about trust. Without privacy guarantees, people may resist adoption. Global lessons, what the world learned. So what exactly are other central banks learning from China's experiment? It's technically possible the digital yuan proved a CBDC can function at scale. Millions of people used it daily without major breakdowns. That reassured policymakers globally. Adoption is harder than expected even with free giveaways. Adoption wasn't explosive. Why? Because private payment systems were already so convenient. This lesson is critical for countries like India, where UPI is dominant, or the US, where cards and PayPal work seamlessly. Bank stability must be protected. China showed how CBDCs could threaten bank deposits. That's why many countries now propose caps on how much CBDC one person can hold. Cross-border potential, perhaps the biggest strategic lesson. China used e-CNY in cross-border pilots with Hong Kong, Thailand, and UAE. This showed that CBDCs could bypass SWIFT and reduce reliance on the dollar. Global banks and governments paid very close attention. Programmable money is powerful and dangerous. Imagine stimulus checks that expire in 30 days. Or subsidies that can only buy food, not alcohol. China tested this. While it offers efficiency, it also opens the door to government overreach. These lessons now shape discussions in the IMF, World Bank, and G20 meetings. China gave the world a live demo of the future. So what's next for the digital yuan and CBDCs in general? China is likely to expand usage in international trade, especially with Belt and Road partner countries. They want to settle oil, gas, and commodity trades in e-CNY instead of dollars. If successful, this could weaken the dollar's global dominance. For other countries, the race is on. The EU is preparing for a digital euro by 2026. India is scaling up its digital rupee pilots. Dozens of African nations see CBDCs as a way to reduce cash printing costs. But the biggest question remains. Will citizens trust digital money issued directly by governments? The technology works, the psychology is harder. The digital yuan isn't just a Chinese experiment. It's a blueprint of the future of money. Proved CBDCs are real, scalable, and game-changing. But it also exposed the risks. Privacy trade-offs, banking disruption, and adoption hurdles. Other central banks are watching closely. Some will copy China's successes. Others will avoid its mistakes. But one thing is certain, the global financial system will not look the same in 10 years. So the real question for you is, when your country launches its CBDC, will you embrace it or resist it? Thanks for watching. Don't forget to like this video, subscribe for more deep dives on finance and technology, and drop a comment. Do you think CBDCs are the future or a threat to privacy?